Washington. A compromise tax reform bill would modestly expand the number of New Yorkers who could continue to write off some of their state and local taxes on their federal returns, tax experts said Thursday, but Democrats continued to grouse that the state would lose out under the tax legislation because it trims the so-called SALT deduction. In their final version of tax reform legislation, House and Senate negotiators agreed to allow taxpayers to write off up to $10,000 in property taxes, income or sales taxes, or a combination of property and sales or property and income taxes. For New Yorkers, that's an improvement over the previous versions of the tax bill, which would have only allowed taxpayers to deduct $10,000 in property taxes. But it falls far short of the standard set in the tax code since the income tax was established in 1913, which said taxpayers could deduct every penny they paid in state and local taxes. Tax experts said the change in the final version of the tax bill would largely benefit higher income taxpayers who don't own their own home. "I definitely think it's going to affect a fair number of people in New York," said Stephen Elwell, Vice President of Level Financial Advisors in Amherst. Senate tax bill to include partial SALT deduction. Elwell cited several types of taxpayers who could benefit from the change. The change is likely to have a greater impact in the New York City area, where a large number of higher income people rent rather than own their homes, said E.J. McMahon, founder and research director of the Empire Center for Public Policy, a right-leaning Albany think tank. "It only means something to higher income people," McMahon added. "That's because the tax reform proposal would nearly double the standard deduction, to $24,000 for a married couple, meaning far fewer people would need to itemize. Those that continue itemizing would want to do so only if they could combine their SALT deduction with a mortgage interest deduction, charitable deduction, and other write-offs that total more than $24,000, a level that only higher income taxpayers would reach." One other change in the latest version of the tax reform bill could ease the burden on higher income taxpayers that will lose out under the reduced SALT deduction, McMahon noted. That would be the final plan's reduction of the top individual tax rate to 37%, down from 39.6% under current law. Even with those changes, local tax experts predicted the tax bill would provide little joy for upper-income New Yorkers compared to their counterparts in other states. That's because the dramatic reduction in the SALT deduction will still clobber wealthy people in high-tax states such as New York. "For people paying significant taxes, there will be faint praise for this," said Anthony Ograk, a Williamsville financial planner. But among Republican members of Congress, there was plenty of praise for the emerging House-Senate compromise tax bill and its expansion of the SALT deduction in comparison with earlier versions of the bill. "Obviously this is an added step we've been advocating since day one," said Rep.